Have you ever wondered why highly paid economists get it so wrong? Think back to the year 2021. Inflation was surging across the globe, yet central bank officials confidently called it transitory. They missed the biggest economic shift of our generation. I find this absolutely fascinating. How did the brightest minds fail so badly? And more importantly, what is replacing them today? Today, I want to take you on an analytical journey. We will look at the death of traditional forecasting. We will explore the incredible rise of prediction markets like Polymarket and Kalshi. We will also dive into artificial intelligence and hybrid econometric models. Let's look at the data. Let's find out how we will accurately predict the future. Make sure to watch until the end, because the ultimate solution is not what you might expect. For decades, macroeconomic forecasting belonged exclusively to institutional bureaucracies. Central banks and elite investment banks used complex mathematical models. These models assumed the past is a reliable guide to the future, but they struggle heavily with sudden structural breaks. We often call these black swan events. During the pandemic, traditional models failed completely. In fact, a brilliant study by the Federal Reserve Bank of Chicago found something shocking. Regular households actually predicted inflation better than professional forecasters during the pandemic. Why did this happen? It comes down to human incentives. In a large bureaucracy, the incentive structure rewards conformity. An economist does not want to be the only one predicting hyperinflation. The safe bet is to stick to the consensus narrative. Therefore, experts often miss massive shifts. They prioritize job security over pure predictive accuracy. This brings me to a massive shift in how we gather information. Enter prediction markets. You've probably heard of platforms like Polymarket or Kalshi. These platforms allow anyone to bet real money on future events. You can bet on elections, inflation rates, or Federal Reserve decisions. Prediction markets turn human expectations into hard prices. If a contract trades at 65 cents, it implies a 65% chance of that outcome happening. I think the brilliance here is the incentive structure. If a traditional central bank economist is wrong, they keep their job. If a prediction market trader is wrong, they lose their own money. This concept is called having skin in the game. There's a mathematical foundation for this success. It's called the diversity prediction theorem. It states that a crowd's accuracy depends on the diversity of its perspectives. You do not need a crowd of experts. You just need a crowd with independent information and a financial reason to be right. The Federal Reserve recently published a working paper validating this entire concept. Researchers found that Kalshi's markets match and sometimes completely outperform traditional forecasting tools. For example, Kalshi's forecasts for the federal funds rate performed on par with professional forecasters. On the day before a Federal Reserve meeting, Kalshi actually showed a perfect forecast record. Prediction markets also beat the Bloomberg consensus for headline consumer price inflation. Furthermore, prediction markets provide real-time updates. Traditional surveys give you a static snapshot every few weeks. Prediction markets give you a continuous, live probability distribution. They show not just the most likely outcome, but also exactly how confident the market is at any second. This is a total game changer for real-time analysis. Major exchange operators are noticing this trend. Companies like the Chicago Mercantile Exchange and Interactive Brokers are getting involved. Wall Street sees prediction markets as a vital new alternative data set. They use it to separate signal from noise. About 60% of market specialists now view prediction markets as a valuable source of data for speculation and hedging. Even massive tech companies use these tools internally. Google ran internal prediction markets called Profit and Glean for years. Google found that internal markets often outperformed their own senior executives. These markets surface uncomfortable truths. An engineer might know a project is delayed, but fear telling the boss. In an anonymous prediction market, that same engineer can bet on the delay and profit. However, corporate markets often struggle. Why? Because middle managers usually want to control information rather than discover the hard truth. But I must be objective here. Prediction markets are not a flawless crystal ball. Critics correctly point to the risk of manipulation. What happens when a very rich person enters the market? We call them a whale. Can a whale buy a false narrative? A recent agent-based modeling experiment explored this exact question. The researchers found that whales can indeed introduce temporary price distortions. The size of the distortion heavily depends on the whale's budget share. If they have enough money, they can move the price. However, these markets are usually highly self-correcting. Other sharp traders quickly step in to grab the easy profit. They bet against the whale and bring the price back to reality. The real danger occurs when regular traders show herding behavior. If normal bettors blindly follow the whale's fake price shift, the distortion lasts much longer. Thin liquidity also amplifies this specific problem. So we must interpret prediction market prices carefully. They are highly useful signals, but we should never treat them as unbiased, absolute truths. So crowds are smart, but what about machines? Artificial intelligence and machine learning are currently revolutionizing forecasting. Deep learning models, like long short-term memory networks, can process massive datasets. We call them LSTMs. They capture complex, non-linear relationships that traditional econometric models simply miss. Many studies show ML models outperforming traditional methods. However, the data tells a much more nuanced story. A recent academic study looked at forecasting inflation in Romania. Romania faced massive inflation shocks recently. The researchers compared machine learning methods against a traditional econometric model called ARDL. They also added a brilliant twist. They used natural language processing to extract a sentiment index from the central bank's official reports. Surprisingly, the traditional ARDL model combined with this text sentiment data actually outperformed the machine learning techniques. Why did the machines lose this battle? Machine learning models easily overfit training data. They learn the noise along with the actual signal. They also act as black boxes. They lack the clear structural rules of economics. This shows us that simply throwing raw data at a neural network is not a magic bullet. Context matters. We do not have to choose between traditional math and modern AI. We can combine them. I firmly believe the future belongs to hybrid models. A hybrid model blends the statistical rigor of econometrics with the pattern recognition of deep learning. Let me explain how this works in practice. You start with a traditional model like ARIMA or GARCH. You use it to map out the basic linear trends in the market. Then you take the errors or residuals from that model, and you feed those errors into a deep learning network like an LSTM. The neural network learns the complex, hidden patterns that the traditional model missed. Studies clearly show these hybrid models significantly reduce errors. They perform exceptionally well during high volatility periods, like the COVID crash. You get the absolute best of both worlds. You get the stability and interpretability of traditional economics, and you get the flexible nonlinear power of AI. We can take this even further. We can build ensemble hybrids. We can fuse traditional consensus estimates, machine learning outputs, and live probability data from prediction markets. We can also feed these models alternative data, like news sentiment or social media trends. This creates a robust, highly adaptable forecasting engine. It uses every available tool. We are currently witnessing a massive shift in the global economy's epistemic infrastructure. The era of relying solely on centralized experts and rigid historical models is effectively over. The future is decentralized, fast, and dynamic. Prediction markets give us the real-time wisdom of the crowd. They are backed by real financial stakes. Machine learning gives us the raw power to untangle complex data webs, and traditional econometrics provides the solid structural foundation we still critically need. The most successful investors, businesses, and policymakers will not rely on a single source. They will integrate all of these tools. They will use prediction markets to see the what and when in real time. They will use hybrid econometric models to truly understand the why. I want to know your thoughts. What do you think about this massive shift? Would you trust a prediction market over a central bank economist? Have you ever traded on platforms like Kalshi or Polymarket? Let me know down in the comments below. If you found this analysis helpful, please hit the like button. Subscribe to the channel for more objective deep dives into the future of finance and technology. Thank you for watching, and I will see you in the next video.